It's a pleasure to have you with us today for this webinar co-hosted with the Crypto Valley Association, along with Bitcoin Suisse. Today, we're focusing on the investment side of crypto assets, with a particular focus on the latest publication from Bitcoin Suisse, which is entitled the Bitcoin Suisse Investment Digest. And today we'll have, first of all, a presentation from our head of research at Bitcoin Suisse, Dr. Marcus Dapp. He'll walk us through the investment digest, what it contains, some of the details of what we see as blue chip crypto assets at Bitcoin Suisse. And following that, we'll have a very interesting panel discussion with two guests, along with Dr. Marcus Dapp, Alexander Thoma from Post Finance, as well as Dr. Demelza Hayes, who is Director of Research at Cointelegraph. But first of all, as I said, a presentation on the digest from Dr. Marcus Dapp. So over to you, Marcus. Take us away.
Yeah, thanks a lot, Ian. Let me share my screen. So, all right. So yeah, good evening from my side as well. Thanks to the Crypto Valley Association for hosting our webinar tonight. And thanks to the panelists for joining us as well for a lively discussion afterwards. Towards Crypto Blue Chips is the title of the presentation. And does it move? It doesn't. No, it moves. And as maybe some of you might expect, we are still not giving financial advice in this presentation and in the investment digest in general. But we hope we are able to provide interesting information and insights for you to do your own research and do your own decisions around crypto investments. A quick word on Bitcoin Suisse. I guess a lot of people know the company. In Zug, one of the pioneers, 2013 until today. A few of the numbers, we're offering a range of services around crypto brokerage, custody, staking, etc. So if you're interested, visit the website to learn more. My area is research. Here is an overview of the publication we bring out. So from left to right, we have a few regulars on a weekly or bi-weekly basis, which are the weekly rep and the decrypt. We have a yearly publication, which is called the Outlook. And our newest publication that just came out a few weeks ago is the Investment Digest, and I'm happy to introduce it tonight to you. And we chose the title of Blue Chip Crypto Assets because we thought it would be interesting to start a format that is also geared towards TradFi investors with digesting and dissecting the crypto space a bit more. So in a sense, the idea is to bring together all this information and data people can find online about crypto and distill a few bits, we hope at least, of knowledge and insight to help you make better decisions in this space. So the new publication format is quite investor-oriented compared to the other periodicals we have. It's, as I said, geared towards a TradFi audience. So for the more advanced or more experienced crypto investors, you may find a few basic information that you already know, but we also hope that you learn a few more things and look at the different tokens we present and the different asset classes in a different way afterwards. We try to follow as much as possible a systematic approach, but nevertheless, it's first edition, so we are very happy to receive your feedback to that edition to make all the coming ones better. Let me start with asset classes. So currently, the crypto space is considered to be one new asset class. Some people even would say it's not yet an asset class. I think we should go a step further and actually dissect this crypto space into what I would call crypto asset classes, because it's a multiverse. If you look at CoinMarketCap or any other of the long lists of coins and tokens existing, there are very different groups of tokens that behave very different, form their own universe. And so it makes a lot of sense to consider these groups, clusters, universes on their own merits. So we would interpret these different universes of in the crypto space as asset classes with intra-class similarities. So as you can see on the right side, cryptocurrencies have different specific properties compared to smart contract chains, DeFi protocols, or multi-chains. But there is no, there's no claim for completeness. It's a first proposal of how we could dissect this crypto space. And I'm also sure we will have quite a dynamic development of these classes in the future. So it's a start. So let's jump right in. We chose the term blue chip and the topic of blue chips to give TradFi investors who are new to the space and are facing this staggering long list of different tokens and coins to provide guidance. And in TradFi, a blue chip is, as you can read here, a recognized, well-established and sound company. You think of the Dow Jones, the DAX, the SMI, and other indices around the world, and you get an impression what blue chips are. Now, the crypto space is very young. Bitcoin being the oldest is 12 to 13. But I think it still makes sense to define blue chips in that space as well as widely recognized, well-established, and financially sound blockchains or protocols. So we are not considering companies, we are not considering CeFi institutions in that space. The first one may not be surprising at all. It's Bitcoin, the first earliest example of a coin and the project that started and established the entire crypto space. It's been the best performing asset in the decade 11 to 21. When you compare it with all TradFi and all other crypto asset classes or tokens or coins or shares, it's been the best performing asset over a decade. It's now legal tender in 2 UN states, which are El Salvador, everybody has probably heard, and the Central African Republic is the second one. And finally, for the ones who followed the space last year, the Bitcoin network showed quite strong resilience when China was banning Bitcoin and particularly banning Bitcoin mining. And as you can see on the chart here, which is also taken from the digest, in summer of 21, we are not seeing the full fall, but during this time, the mining ban of China was in full swing, which led also to a drop of the hash rate. So the hash rate is the sum of all computing power of all the computers that mine Bitcoin and make sure the network is secure. So it dropped quite considerably as well. But what this chart shows is the resilience of the network, that only half a year, 6 to 9 months later, the hash rate recovered fully. And since then, even with declining prices across the board, has been increasing slowly but steadily, ever making the network more secure. We also, for each of the tokens presented in the digest, we are having a table with key metrics. and a snapshot of the metrics and an overview of the ecosystem of the particular asset. So here in the Bitcoin space, as most of you most probably know, the defining feature, or one of the defining features, is Bitcoin's strict cap on the supply, which is 21 million Bitcoin units. And this particular monetary policy that leads to a decreasing inflation, or more concrete, new issuance rate, which you can see on the top right, which currently hovers around 1.76% on an annualized basis. That is still more than gold, but after the next halving, it will be less than gold because it will be half, so 0.8. And that will be the first time an asset is actually more scarce in terms of stock to flow ratio and the inverse issuance rate than gold. So that will be interesting to watch in 2024. Notable players in the Bitcoin ecosystem. You may have heard of various forks, of course, other cryptocurrencies that are cryptocurrencies primarily. Notable companies are mentioned. But what I want to highlight is the top section, notable projects, because I have the impression that Bitcoin is still viewed mainly as a payment network. Some say a failed payment network because you cannot buy your coffee with the base chain of Bitcoin because of fees and the 10-minute transaction time. To those people, I'd like to highlight the fact that there is a lot of development going on layer 2 and layer 3 even in the Bitcoin ecosystem. So layer 2, of course, is the Lightning Network, which allows for immediate instant payments that are nearly free and go without mining. If you haven't heard about it, I invite you to read on the Bitcoin Lightning Network, because many of the newest developments are happening on that layer, notably layer 3 projects that try to bring digital asset, aka tokens or smart contracts, to the Bitcoin ecosystem, mainly on layer 2. Notable projects are RGB and Taro recently. The next asset class is smart contracts, and here we also chose or picked a project everybody is aware of and knows. It's the project that's been inventing smart contracts a few years ago, made the first real-world implementation of the idea of smart contracts. It's the second largest permissionless blockchain after Bitcoin, and it evolved into a critical infrastructure for many Web3 projects to date. And of course, this network is Ethereum. I looked it up this afternoon. It's home to 50,000 ERC tokens. So ERC20 tokens are payment tokens that are implemented as smart contracts on the Ethereum chain. So it's by far the largest smart contract environment in terms of developer attention, resources flowing in, projects, tokens, etc. And it's the thing everybody is waiting for, the upgrade to Ethereum 2.0, or the major milestone in the upgrade to 2.0, which is the merge, the move from the proof of work Ethereum blockchain to the proof of stake chain, probably happening in the middle of September. What you also can see here in the chart is a reflection of these many tokens that are built on Ethereum, which is measured usually as the total value locked, which, as you can see, is in the billions. So the Ethereum network is actually securing quite a large amount of funds in the crypto space. A few more metrics, which I'm not going too much into detail. The interesting thing here is also related and connected to the merge. because the issuance rate will be balanced by a burn rate, also, of course, after the merge. And it will be interesting to see how the monetary policy actually will work out and develop. There's a whole movement in the Ethereum space talking about ultrasound money, because the claim is that Ethereum will be much more restricted than Bitcoin is in the issuance of new tokens. And yeah, the people of the ultrasound money camp expect that to be reflected in the price in the mid to long term. Notable projects in the ecosystem or players. What you also can see here in the top, in the notable projects section, is there's quite some competition. Yeah, being the incumbent is a success story, but Ethereum is increasingly facing competition on layer 1 as well as on layer 2, in terms of fees, in terms of speed, etc. So it's interesting to see how that competitive landscape will play out, what dynamics will play out after the merge. And of course, there are a few companies. There are more, but the most relevant companies in that sense are Consensus and Infura, who runs a lot of the nodes. The third group asset class are multi-chains. We use the word multi-chains. There's also talk about interoperability chains or interoperable chains. We, for the moment, went with the term multi-chain because I think it reflects most closely the idea of projects like Polkadot and as you can see here, Cosmos and others. The idea here is not, so comparing it to Ethereum, the idea is not to have a blockchain as the basis of all kinds of decentralized applications, smart contracts, and tokens on top, but to have a much more decentralized and much more heterogenic setup, where the chain, in the case of Polkadot, it's called the relay chain, running with DOT, the native token, that has the primary purpose of connecting quite heterogeneous blockchains called parachains, parallel for parallel chains, and enable communication between all these different chains. So interoperability is at the heart of the concept, and Polkadot is the largest of these multi-chain projects. And as you can see on the chart, yeah, over 20 parachains have launched so far and committed DOT, stake DOT in the process. And you can see here it's yeah, quite some money is secured as well in the Polkadot network already. And as I said, the important thing about Polkadot is the ability that these different parachains, no matter what they do and how different they may be, are able to exchange information in a secured way through Polkadot's relay chain. A few numbers again. Here you can see the issuance rate is close to fiat rates, let's say. So it's quite high compared to what we've seen before. And of course, the notable space is the space of the different parachain projects. They are around data availability, IoT, NFTs, DeFi, of course, smart contracts in general. So there are many, and it's a growing space, which allows for a lot of innovation on layer 1 as well, right? So the different projects try to build either better versions of existing chains, competing, for example, with Ethereum, here in the case of Moonbeam and others, but also trying very new things as well, with the view of benefiting from a larger network from the get-go. Finally, the last asset class is DeFi protocols, not chains, because we don't have the DeFi blockchain, but DeFi is happening mostly on layer 2, be it on Ethereum or on other chains. The dominant DeFi player on Ethereum, and maybe also on different chains in the future, is Uniswap. Uniswap is a decentralized exchange, which is one of the key use cases in DeFi, as you can imagine. If you have a whole universe of different tokens, you need a place that is decentralized, trustless, set up according to the principles of DeFi and Web3 that allows you to swap tokens. Uniswap is that place. It's has been showing very stable development up to version 3 today, and became immediately famous a few years ago when it through one airdrop spread its native token Uni into 50,000 wallets and was instantly one of the largest DeFi protocols from the start, and continues to be the largest. Also here, a few metrics. Watch the issuance rate here. So that's actually an interesting metric that you could investigate in the blockchain projects you're interested in. Inflation is also a topic in crypto, not just in fiat. And yeah, we have, of course, a few competitors that sometimes only play on the name, sometimes take parts of the code. Yeah, but none of them has the relevance of Uniswap. All right, with that, I'm already at the summary because I'm not showing you the entire digest, of course. So half of the charts are still there and I haven't shown them. I kindly invite you to, in case you have not read it, to read it. Here's a link for download. I leave the page for a few seconds so you can take a photo if you like. And maybe as an input also to the discussion, I'm happy to discuss and I'm interested in learning what the panelists think about this idea of crypto not being this one asset class, but being a multiverse and having its own asset classes, and how you see the 4 we are proposing. And yeah, first edition of the Investment Digest, and there is for sure more to come. And with that, thanks a lot, and I'm handing back to Ian for questions. Let me switch off my...
Yes, thank you very much, Marcus, for the short overview of the Investment Digest. Of course, we generally invite everyone to read it in depth and learn from it. Maybe just a brief question to start with. I think I know some of your thinking behind the digest, but give us a little bit more insight into why these 4 particular categories, if we think high level of crypto as a multiverse, but why these 4 categories? What were the reasons or the criteria for that?
Yeah. I mean, the first one is cryptocurrencies, which is the asset class subsection category that was the first. In the beginning, there was no other thing than cryptocurrencies. Bitcoin was the first, and then there were several projects, Litecoin and others, and forks of Bitcoin, that all had the goal of allowing people to buy and sell and hold these assets as currencies. There was no talk and no possibility to do more with them than payments and store of value. What you would expect from money by design. So it's quite natural to have this original first group in there. And then, of course, with Ethereum and later on other projects, the space diverged and became more heterogeneous. And again, there was a first player, in that case, Ethereum, who said, well, let's take the idea of immutable transactions that can be used for payments. And instead of putting numbers inside the transaction, put a piece of code that then becomes immutable and can run in a decentralized fashion. And let's think about what you can do with that idea. So it makes a lot of sense to put smart contract chains into a bucket. It's true that bucket is quite large. And at one point, it may make sense to cut it into more specific subsections, maybe. But for the moment, I think it's okay to have it this way. To also, well, yeah, we also don't want to have asset classes to be very small, which brings me already to the next group, which at the moment we propose as multi-chains. So the argument to have it is multi-chains are different to, I explained it earlier, it's different to, in the smart contract space, you have this one base chain that provides smart contract functionality, and on top you're not experimenting with chains, you just build tokens and smart contracts and decentralized applications on top, but you are sort of restricted to that chain. And unless you have bridges to other chains with all the challenges that are connected to building bridges, you're restricted to that space and the rules of that chain. Whereas in a multi-chain setup, like with Polkadot, but also with Cosmos, you say, okay, we accept or we expect in the future that different chains will be around and they will be doing different things for different, like fulfill different needs. But we still like them to be able to communicate and not have silos, because it's economically, it doesn't make too much sense. And from a technology point of view, it's a nuisance as well. And so there, the idea is to stay on the same layer, don't build on top of it, but have them all on the same layer. And Polkadot, the Polkadot community is even talking about layer 0, indicating that the Polkadot protocol is sort of below the parachain blockchains. You can look at it this way, or you can say they're all the same and just interconnected. But yeah, it's true. It's a much smaller group of projects than the smart contract group is. And of course, they also use smart contracts. You could also enter them into the asset classes or asset class of smart contracts. For the moment, we think they behave differently and have a different dynamic to homogeneous smart contract or monolithic smart contract chains. But yeah, also happy to hear what the panelists think afterwards. And finally, DeFi. I think it makes a lot of sense to have DeFi as its own asset class, in the sense of these are transfers of traditional financial instruments into the decentralized world. Many of them happen on Ethereum, but not only. There's smart contracts on other chains as well. So the word DeFi alone doesn't imply necessarily Ethereum. For the moment, it's very often Ethereum, but it doesn't have to. And inside DeFi, of course, you have different types of instruments. Decentralized exchanges are a group, lending protocols are a group, synthetic assets are a group, and then there are more. In the case of DeFi, at the moment, we didn't want to go into one step deeper because it's still a very dynamic space, and the how to say, the landscape is moving quite fast. Stuff that was there and was huge is gone a few weeks later, as we have learned 2 months ago with certain stable coins. So yeah, it doesn't make too much sense at the moment, I would say, in terms of maturity of the DeFi space itself, to go very much into the detail, into subsections of it. And then again, Uniswap is a very stable, a very old, in quote unquote, protocol in the space, performing a crucial function and doing it well. So it was a good or clear choice for us to pick Uniswap for that.
Understood.
What we haven't shown, just to really answer the question fully, what we haven't shown, we are not talking about NFTs, for example. We are not talking about metaverse, and also a few other areas. NFTs, for all the hype and all the experimentation and everything that's going on in the NFT space, having a cluster or an asset class that we would call NFTs doesn't make too much sense to me in terms of how to structure the space, because an NFT is not, it's not the user perspective we are taking, right? An investor does not invest in NFTs. They invest in maybe pieces of art as NFTs, maybe in protocols that do something else with NFTs, like ticketing or gaming or land, whatever. But then the NFTs behave differently. So NFT is just a technical term for a type of token, and I think that doesn't warrant for an asset class.
Understood. Thanks for the in-depth overview on that. I'll give you one follow-up question from our audience, one of our very engaged, shall I say, Bitcoin-focused community members, talking about a blue chip crypto asset. If you would define it as a financially sound blockchain, how is it that Ethereum, where the issuance rate and the supply is not fixed, could be considered a blue chip crypto asset? And that leads into maybe the follow-up question, and then we'll jump into the panel discussion. Is it just about the asset as an asset with its financial policy, or in the crypto space, and this is something which maybe new investors, professional investors from TradeFi coming into the space have to understand, that there are more technical factors, ecosystem factors, and network factors that play into the value of a token beyond just the protocol level financial system?
Mm-hmm. Yeah, Lucas, great question. So for the moment, and I agree with the how to say, the skeptical view of the question. It is true that we are not 100% sure how the monetary policy or the effects, let's put it this way, the effects of the monetary policy will be playing out. And for example, let's say summer next year, let's assume the merge takes place, is successful, like no technical problems, etc., and we're moving on. There are a ton of simulations for all kinds of possible developments. That's true, but we are not really sure how it works, or how it will be really playing out. But at the same time, looking at all the smart contract chains at the moment, Ethereum has been behaving reasonably sound in terms of monetary policy so far. Sure, with every hard, well, not with every, but every other hard fork, parts of the monetary policies have been changing. That is true, but that's literally the case for nearly all the chains except Bitcoin. And yeah, so it's not about and that's also a point about talking about asset classes. We are proposing these grouping to discourage, at least to a certain extent, comparisons between asset classes. So comparing Bitcoin with Ethereum, which many people like to do a lot, maybe doesn't make so much sense, because it's two different things, as the questioner implied, have different properties, not only technical properties, but also economic properties and serve different purposes. There's a reason why no country in the world chose Ethereum as a cryptocurrency, as legal tender, right? But nearly all projects that go about writing something around smart contracts, have some idea for some decentralized application, have been using Ethereum. And at least so far, the monetary policy hasn't been preventing them or hasn't been breaking down, etc. I agree. It's not the same as the same stability and predictability, and as we would like to see. But let's also see what the competition does, right? So Ethereum is competing with other smart contract chains, and if users realize that there are differences in monetary policy and it makes a difference on which chain you are with your project or the app, I would just say the market will play out. And just because we took Ethereum now as the blue chip in the smart contract chain space doesn't mean it will stay there forever, right? If the assessment changes because the project changes, and I mentioned layer 2 and 3 in the Bitcoin space, so there's also stuff going on. Let's see. But for the moment, I think we are okay with the way we did it. Yeah.
Very good. With that, I'd like to open up the panel discussion. We have two great guests with us today, as mentioned already. First of all, Dr. Demelza Hayes. She is Director of Research at Cointelegraph and also Crypto Portfolio Manager at Zeltner & Co., as well as Alexander Thoma, who is Head of Digital Assets at Postfinance. So let me throw the question out based on what Marcus showed and the discussion and Q&A so far. We talk about different asset classes within the new and developing crypto asset class. How far or how sophisticated do you think professional or traditional investors are in understanding this space? And I would maybe start with Alexander, since you, shall I say, represent a more traditional financial institution here in Switzerland, which also is getting into this space. We won't dive too much into the details of that, but obviously Postfinance has an interest in crypto assets, digital assets. How much do you think people understand this, and how much do they need to understand in order to invest in crypto assets?
Okay, thank you also from my side. I hope you can hear me. All right, great. So good question for the start. I think that when we think about crypto as an asset class, or in general crypto assets as an asset class, I think that's about to sink in really into traditional finance. And I don't think there's any bank in Switzerland that is currently not discussing the crypto topic at the very top management. So therefore, I think it all starts with adoption. What I don't think what is yet mainstream is the view of Marcus regarding the 4 different kinds of asset classes within the asset class of crypto. I think that is maybe a little bit next level for the mainstream investor. I think that traditional finance investors view this as the 5th asset class, but then just make a distinction between different kinds of cryptos with different kinds of flavors. And I don't think that they would sort of coin the term sub asset class as they wouldn't do that for stocks as well. I think just as it is with stocks, there are just different types of sectors, for instance, and then we just derive a sector allocation with all the cryptocurrencies that are out there. Does that make sense?
Yes, yes. And maybe just the follow-up question. I mean, now jumping into the space, you've seen obviously some demand or some appetite for this with Postfinance. Where does this come from? Does this come from more professional investors or retail investors? Do you think this is an add-on or a real strategic shift for your clients?
Yeah, so it's actually twofold. So I would say first and foremost, we identified digital assets and cryptocurrencies in specifically, right, as a strategic focus field. I mean, we use the term digital assets, but what we actually mean is crypto assets, right? We just subsume cryptocurrencies under that. So we see that as a very strong field going into the future, and we believe in the fundamental technology behind it and the various use cases that they bring. So we want to position ourselves as PostFinance in that market. And on the other hand, we have a lot of push from clients that want to access to this market at their house bank. This is what we really see. So there's a need for services around crypto and products around crypto that our clients have, and that they want to sort of like fill that need with us, actually, to be honest, right? So they see crypto on investments in crypto as any other financial activity that they do, right? Like investing in stocks and so on. And they just want to do everything at the same place. I mean, of course, there are like outliers, or let's say 10% of people that still want to do this stuff on their own with self-custody wallets and go to exchanges. That's fair enough, right? I'm one of those 10%, but let's say the 90% of mainstream retail investors wants to handle this at their bank. And this is where we come in, having 2.6 million clients in Switzerland.
That's quite impressive. That's a lot of clients, to be sure. Do you, just follow-up question, just out of curiosity, do you provide advice or guidance or education for the clients, or do you plan to do that going forward?
We're going to start with a execution-only offer, but education is a hot topic inside our organization, both internally and externally. And we want to provide something in terms of education to our clients as well. But it's too early to announce anything specific. But we will come up with something very interesting and also that will be of great value to our clients.
I'm sure you will, and we'll be looking forward to that. Let's turn over quickly to Demelza. You are focused on core crypto topics with Cointelegraph, but also more, shall we say, traditional financial products with the AMC, with Telton & Co. That has quite a broad basket and composition. But stepping back, when we think about a maturing crypto asset space, which can be now brought to the public in financial products like this, do you think we are already at a tipping point where the crypto asset space is bankable in that sense? And if not, what else would need to happen for that to be the case?
Well, good question, Ian, and thanks a lot for your new research report, Dr. Dapp. It was a good read. And yeah, to get to your question, well, I think that, we've seen BlackRock announce that they're going to come in with a private trust for their institutional clients. And I think that BlackRock did this after there was regulatory clarity in the US. And I think that over time, as there's more regulatory clarity, so for example, Gary Gensler at the SEC has said that Bitcoin and Ethereum are not securities. And I think that there's, it's our job to educate investors that these aren't securities, and that there's more and more regulation across Europe and Asia and North America to bring clarity and confidence to the large investors. And I think that as that continues to become stronger, I think that more investors with institutional status will come into the space. So I think we are seeing a great position for cryptocurrencies. one of the things that we're doing at Cointelegraph is we're doing a survey of professional investors, and we did this 2 years ago. And at that point, we had 36% of investors saying that they had invested in crypto, professional investors, and now it's up to 44%. However, regulation is still one of the main reasons for the people that said no. So I think that regulation clarity is a big topic for institutional investors.
Okay. And I'll continue with you, Demeltse, just diving down more into the financial instrument which you are managing there. I took a look at the portfolio allocation today online. Very interesting that I think it is 21% Bitcoin. Very interesting number there. 15% Ethereum, as well as altcoins and some other things. When you think about what Marcus showed from our investment digest as far as different asset classes and blue chips, how was that decision made for the composition of the AMC which you're managing?
Great question as well. So I do think, talking about Dr. Dapp's categories, I think that he's onto something here, because there's different correlations between the tokens within cryptocurrencies. And we've seen in our portfolio that on some days, for example, Compound and Maker in the last week didn't perform very well. They're in Dr. Dapp's DeFi category. But on the other hand, BNB, Build and Build, Binance Token, and Solana both performed very well this past week. And so we saw that kind of the layer ones with smart contract capabilities did do well this week. So I think that, you have, it would be interesting to study the correlations between these different groups that Dr. Dapp has presented. And I think that, within our own portfolio, I like to look at the different revenue models of these tokens. So for example, you have this thin and fat protocol thesis. And I think that, the idea is that if you take the internet as a technology stack, you have, TCP and VoIP kind of as these bottom layer technologies that these applications like Facebook or Skype are built on top of. And in that thesis, they basically argue that the bottom layer protocols did not garner that much investment, whereas the applications built on top of TCP and VoIP, they are the ones that attracted a lot of capitalization and investment from investors. And also they had a revenue model that they could have revenue streams from customers. On the other hand, cryptocurrencies, in my opinion, we've seen the opposite so far. So we've seen these protocol layers that have attracted large capitalizations like Ethereum, Bitcoin, Polkadot, et cetera. And then the application layer on top, for example, Uniswap or Moonbeam, they have attracted capital as well, but not as much. And so I think that, looking at kind of the flip between, the internet and the web and blockchain technology, I think is interesting as a way that we've kind of categorized it. And I think to that point, for example, tokens like Uniswap or, BNB, I think that they kind of represent exchanges and exchange activity. And I think that that's a uniquely different revenue stream and business model than other cryptocurrencies that might be, focusing more on utility or medium of exchange and payments. So I think that there's definitely something here, and the answers to this discussion and this question and this research will help portfolio allocation, because we will be able to understand better the relationships between these coins and how they add diversification benefits and ultimately increase the risk-adjusted return. So I think it's a great research piece and deserves a lot of attention and maybe some statistical analysis to investigate these relationships further.
And Marcus, what would you say, just building on top of that, the base layer focus versus the application layer focus, would you say that's generally been true? There's been more interest. Obviously, they've been developed first, versus the application layer coming second in the
Yeah.
development timeline. But do you think that is a fair thesis to think about?
I mean, I like the idea actually to say it doesn't matter too much whether on which layer we are, but which function we perform. You gave the example of an exchange. Yes, I can see that, and it sounds, yeah, intuitively it sounds logic and a sensible way to proceed. But layer ones and layer twos are not the same thing, right? There's dependency. There's different risks, maybe not financial. Well, by implication, it's a financial risk, but there's technical risk because layer twos. It's much newer technology, or actually we have a bucket of different technologies that are currently in live testing and experimenting. I think that's fair to say, and we'll see which ones survive. And we kind of would, I mean, I think we have to consider this as well. So putting all the DEXs in one bucket because they are DEXs makes sense, but also ignores some of the, I would say, important differences in the risks, as you said, right? Risk-adjusted returns. So we need to consider this as well. But I like the idea in general to go by function rather than by by layer or whatever the alternative would be. Yeah, and of course I agree to the to the argument with the correlations and statistical support to strengthen the structuring of the classes as well as the groupings of the tokens. Yeah.
Coming back now to Alexander, there's a lot of deep stuff here, shall we say? Also in the technical side of things, how do you plan to explain this to investors from post-finance who are going to invest in this space? Or are you going to keep it very high level, just Bitcoin and Ethereum?
Isn't there a saying, never invest in something you don't understand?
Yes.
For that, too many people are in crypto.
Good. So no, I mean, there's a more high level, more straightforward way to explaining at least the basics. I mean, what we're talking about here regarding portfolio optimization, I think that's not a run-of-the-mill education level, right? I mean, that's next level for us nerds in this space, but I don't think a client needs to understand this. I mean, he doesn't understand this with the other asset classes as well, how his portfolio is compromised, how the backbone is set up regarding the portfolio optimization. If he has, for instance, a digital asset management solution that has a fund that invests in different kinds of asset classes, I don't think that the normal run-of-the-mill investor understands this and wants to understand this. He just wants to trust his or her asset manager in that sense, that he takes care of his or her money.
So let's turn back to an asset manager, Demelza. Going back to the portfolio that you manage for Zeltner & Co., the altcoins, which make up a certain percentage of that product, what are they, and how did you choose those? Are they some of the ones which are in the blue chip grouping here, or some others?
We do have all of Dr. Dapp's blue chips in the portfolio. Yeah, basically, when I used to manage the alternative investment fund in Liechtenstein, we were quite limited in what we could hold directly. Now that we have this new product set up, our universe opened up a lot, and we wanted to be able to, gain exposure to a lot more coins that have interesting opportunities. And yeah, so far, we have outperformed Bitcoin by 40%. We also are up 26% in just the 2 months that we've been live. And the coins, the way that we chose these coins is we use various different tools, but I really like using the TIES SIGDEV, which is their significant development terminal. And that they are one of the only, if not the only platform that has full access to the entire Twitter feed of data. So most platforms only have little snippets of data that they analyze. So if you see like a Twitter sentiment score, it's mostly going to be like up to 100,000 tweets that they can afford. But when you get the full access to tweets, you're talking about hundreds of thousands of dollars worth of data from Twitter each year, and they have a special contract. So I use a lot of analysis of Twitter itself for screening new coins and making trades. I also look, for example, at what's going on with Cointelegraph. So I think that a lot of investing is based on for cryptocurrencies is based on the teams behind these coins. So I try to get a call with the developers. I try to get a call with the people that are managing the coin. For example, with Polkadot, reaching out to the Web3 Foundation, speaking to them, or for example, with Moonbeam, I knew about Glimmer before it had even been announced, just because I was, working with Glimmer and Moonbeam on various projects at Cointelegraph. So I like to, for example, Gnosis Safe and their transition away from, the prediction market towards the, the safe and decentralized, custody and stuff. And so I like to follow these projects and really, have conversations with them one-on-one, screen for them. And then once we get them in, we do, just like Dr. Dapp proposed, we basically try to work with the correlation between these assets. So I've seen that, as Bitcoin has a run, traders take gains, they invest them in other interesting projects. As those interesting projects have a good run, they then buy back into Bitcoin and stack more sats, as they say. So I've seen a natural ebb and flow between Bitcoin and the altcoins. And so we've really tried to use, dynamic rebalancing within the portfolio based on back tests to understand when we should, move in between. And importantly, rebalancing is important. I mean, if you look at the Bitwise study, which we replicated and brought up to recent times, so up to the data to the end of June for 2022, rebalancing greatly improves your risk-adjusted return, and that's if you do it yearly, monthly. If you do it based on when it hits a threshold like 50%, it doesn't matter as long as you rebalance. That your risk-adjusted return improves dramatically from just hodling. So I think that overall we basically screen for tokens, and then we make sure that we're rebalancing, and that has really helped us. The other thing that really helped us is that we used market neutral strategies. So when all the indicators that I was looking at, when we saw that when I basically felt based on the data that we were going to continue to decline, we were market neutral and had, we were using CME options trading to basically generate premiums, and we were not going long. So when there's a downturn, we do not go long, we take action, and we basically collect market premiums, which are very profitable. And they have been for years now on the CME, which, Chicago Mercantile Exchange, it's one of the most regulated options markets. And, if you just sell at the money covered calls, or you sell at the money puts, if you want to build a position when Bitcoin, in order to try to take advantage of Bitcoin's volatility, the premiums can be between 3% and 5% per month. And you annualize that, and you're looking at returns that can put many traditional TradFi products out of business. And these are essentially risk-free, because you don't have a long position, you're hedged. So I think that, there's a lot of opportunity, and especially now that the market's turned around, I think it's a great time to be looking at crypto, and I'm generally optimistic about not only Bitcoin, but all the layer ones and all the dApps that are really providing a unique use case.
May I ask a question here, if I may, Ian? So you mentioned the range, you mentioned the range of approaches you follow for the selection process. You haven't mentioned any on-chain metrics. You could measure, I mean, all kinds of things, right? Active addresses, the Bitcoin space is full of more or less fancy metrics on chain. Is that an area you look into, or you use, or not yet? And what's the thinking behind?
Well, we do use Glassnode and Coinmetrics.
Yeah.
We're connected in, and we do, I basically at Cointelegraph, I have to maintain some dashboard of analysis on these metrics. But on the other hand, there can be a lot of manipulation and noise of on-chain data. And so, for example, Tezos, I like Tezos, I'm a big fan, but for a while there was a lot of on-chain data, and a lot of people thought, well, is Tezos, really being used at more so than other blockchains, because the growth in on-chain transactions was enormous. But when I dug into the data, it turned out that a lot of transactions were occurring because of governance, and that when you do a governance proposal and voting, there's a lot of on-chain activity, but not as much economic activity. And so I think that when you look at these on-chain metrics, each token has its own little idiosyncratic variables that you have to account for. Like, for example, on Dash, you have to account for on-chain mixing. For Bitcoin, you have to account for change transactions, right? I mean, so each blockchain has its own transactions that you have to, clean up the data first, and then you can begin to compare. And so I do look at those as well. Mostly, like you said, active user addresses. That's probably one of my top favorites. And then I love all the multiples that allow us to see where we're at in the overall market. So for example, the Mayer multiple, the 200-day moving average, I like to see all the ones that let us know, are we below 200-day? Are we above 200-day? Where are we at? So I think that those are helpful for me as well.
Very good. I'm going to bring one question in from the audience, and then we're slowly going to wrap up our conversation. But this moves into perhaps looking to the future, Marcus. One question is about competitors to Ethereum in the smart contract space. And of course, there are more in the space, whether it's Cardano or, as mentioned here, Binance Smart Chain and others. Will you be looking at those as well in more detail? And can you give us some insights about how you'll be looking at that and what you'll be looking at for the next analysis?
Haha. So there will be a next digest. This is sure. We haven't decided yet on which. But yeah, it's also so the plan is that this first edition sort of shows the landscape, and with future editions we would like to go into specific areas and go deeper. If that is the smart contract, Ethereum and competitor space, I cannot tell yet. We haven't made that decision yet. But for sure, it's a large space, and there's a lot of activity and a lot of also discussion going on right now. Not only, but mainly also because of Ethereum's upgrade process, where you sometimes think everybody's just watching the merge and nothing else. So yeah, we will continue, and we will also go into follow this. While I said putting asset classes or subclasses or makes sense, and it doesn't make too much sense compare between them, it makes a lot of sense to compare, of course, the components inside. And we would like to follow a comparative approach in future digests when we look into a specific asset class in more detail. Yeah, but beyond that, I'm not able to give details right now. So sorry to say, but there's so let's say among the top three, there would be the topic of smart contracts.
And one more question from the audience. Thinking about different ecosystems as kind of foundations, would it make sense to superimpose on top of that analysis of the application economies, with RGB on top of BTC and so on and so forth, Uniswap on top of ETH? Would that be a logical way to analyze asset classes with the interconnections, perhaps, or is that a little bit too in-depth?
Not sure if I understand the question. So the idea would be to take the layer 1 plus a layer 2 in combination.
I believe, if I understand the question.
Sorry. Now I see the question. Thanks. For example, yeah, you can do that. It's just difficult to not do it basically arbitrarily, right? So you have not always, but often you have different layer 2 solutions. So for example, in the Ethereum space, quite a bit of different rollup concepts are currently competing with each other, which is done on purpose even by the Ethereum community, which I think is great and a great idea. It adds quite some complexity to the space, to the analysis if you take this, and any choice is even more. You need. I mean, it's hard to defend the choice. You make a combination choice between a layer 2 and a layer 1. So I would say maybe a few years down the road, when the space has matured and we are not discussing are there asset classes or are they subclasses or are they different, but we have a common understanding and a common agreement among them, and then go a step deeper, maybe we reach a point where we would say it can make sense to look at ecosystems. But to be, for example, because Bitcoin RGB was mentioned, maybe projects also change the asset class. They switch because they evolve and they offer different functionality to what they offered in the past. And then it's not necessarily, and then of course you take the entire stack, because only the entire stack offers the functionality it does. And then I would go with the Melzer's approach and say, okay, which function is performed, right? Is it tokenization of assets that's now possible on that layer 2 or 3, or is it whatever it is, right? But then you would consider the base layer, because the base layer is still a different one to a competing token or project. And I would agree, if that was also part of the question, I would agree that different base layers, I mean, it's a difference whether I have DeFi on Solana or I have DeFi on Ethereum or DeFi on something else, because the security and the design architecture of the base layer, decentralization, scalability, security plays a role, even if the functionality on the higher layer is essentially the same. Yeah, okay. But it's something like quite advanced, I would say, for the moment.
Wait and see. And final question, just to Alexander. You are, I'm sure, looking at all of this and bringing it all together and going to put together a very in-depth education program for the, was it 2.6 million clients from Post Finance who are now going to invest in crypto assets, right?
Yeah, so of course, only those that want it. I mean, we cannot force anyone to participate in the education, but we can surely try. And we will do our best, of course. There are other examples of banks who include a education part for the main base of their clients, and some do it very successfully, and I think that's the goal, right? To have a good education that is fun and easy to do and really brings value.
I can without giving away too much information, say that I am a client of Post Finance. I look forward to the offering and the digital experience where I can learn even more about crypto through the app or through the web portal. It would be actually very interesting to see, and wish you lots of luck on putting that together and building it out. With that,
Thanks, Ian.
I think we're going to wrap things up. We're just after 7 o'clock. Very interesting discussion. Thanks for the insights. Thanks for the presentation, Marcus. And as mentioned, as a short teaser, there will be a further edition of the Bitcoin Suisse Investment Digest. You can find it for download on our main webpage, bitcoinswiss.com. And in the meantime, do your own research as well. And nothing which has been said today is considered investment advice, of course. But let's keep watching the space. Look forward to also what happens with Ethereum and Ethereum 2 coming up. Perhaps more information coming out on that very soon. Thanks again to our panelists, Alexander, Demelza, Marcus. And with that, wishing you all a very good evening and best of luck in the future. Thank you.
Thank you, Ian. Thank you, Marcus and Demelza. Thank you all to the guests.